Okay, can everyone hear me? Perfect. All right, ladies and gentlemen, let's just get this thing started and people can trickle in as they show up. And obviously the recording will be posted. Yeah, it's recording. Okay, perfect. All right, today we're going to touch on I don't want to say fundamental analysis because that's not really going to be the focus, but it's going to be, I guess, fundamental review might be a better way to put it. Just how to simply look at fundamental data and make a conclusion about if a stock is cheap. Now, that phrasing is pretty broad in the sense that I think when people hear, a stock is cheap, they think like, oh, it's trading underneath a certain P or something. But what I'm going to try to emphasize in today's workshop is that it's relative. And it's relative not only in the sense of like comparing it to other stocks in the industry, but it's relative in all metrics, right? It's relative dependent on the opportunity that you think is ahead of the stock, on the growth that the stock has been displaying already, or the growth you think they might be displaying. It's relative to all those factors. It's never absolute. Valuation is never absolute. You can't just look at a stock and say, this stock's trading at 50p, this stock's trading at a 20p. That means stock A is expensive and stock B is cheap. That's not how it works. It needs to be taken on a case by case basis. And another thing we'll talk about is how metrics might vary across different stocks and how um, you might have to look at stocks differently depending on what industry they're in or what type of business they do. So we'll touch on all that a little bit. Obviously, if any of it's confusing, you can ask me questions towards the end. We're not going to do a big Q&A period like for an hour like we normally do because I'm going to touch on this and then we're going to do a chart review and that'll be most of this workshop. But if there are any questions you have while I'm explaining it, while we're going through these topics, then you can ask those as long as they're topical. I'll address them while we're covering this. So, again, as usual, it's not really something I have written out or planned out, but I do have some notes to kind of just guide the conversation a little bit. So I will refer to those notes occasionally. But there's no script or anything, so I might be a little back and forth in terms of the concepts I touch on. But this should give most of you an idea of how to figure out if a stock is cheap. Now, an important thing to keep in mind through all this is that a low multiple, like I said earlier, doesn't mean that a stock is cheap. Okay, cheap means the price is low relative to the value that you have adjusted for. Okay. The risk, the quality of the company, the realisticness of the future cash flows, their competitive position in the industry. All of that is related to perceived value. And what cheap means is the stock, it could be trading at a 50 PE, okay, and it could still be cheap. But relative to that perceived value, relative to the growth, relative to the risk, relative to the quality of the business, relative to the quality of the management, is the stock cheap? So that's what it means to be cheap. Doesn't mean to meet a valuation benchmark. Okay. It's a very, very important concept to understand because I think a lot of times when you guys are asking me about fundamentals for companies, you'll tag me in a stock and you'll say, oh, stock talk, it's at a 25 PE. It must be cheap, right? And it's like, no, not necessarily. I mean, if the business is shrinking, for example, no, it's not cheap. If the business is down 20% year over year, it doesn't matter if it's trading at a 25 PE. That's not cheap for a business that's trading at a 25 PE. So relative growth, relative quality of the business, relative risk, realisticness of future cash flows. All of that is important to factor in when you're determining if it's cheap. So cheapness, this is kind of the overarching point of this whole conversation, is not about meeting a PE benchmark or a price to sales benchmark. It's about the contextual value versus the objective price. And that's um, the effectively what it means to be cheap. Sometimes cheap stocks are cheap because the story is worsening, right? And so you're not trying to predict price action tick by tick when you're looking at valuation. That's not the purpose of valuation, right? For fundamental analysis, that's not the purpose of it. For technical analysis, arguably that is the purpose. You want to have some kind of grasp on price action tick by tick. For fundamental analysis, that's not the purpose. The purpose is to avoid paying for growth that won't show up, right? That's what you want to avoid. You want to avoid paying for growth that won't show up. That's called being value trapped, right? And so that's what you want to avoid, and that's the purpose of determining if a stock is cheap. So a low PE can be like a low sticker price, for example, on a car, right? On a used car. Okay. You might see that and go, great. It's the best price sticker price I've seen for this car. I looked online on, whatever, Car Gurus or wherever you look online, and you're like, oh, well, this is the lowest sticker price I've seen. Is that necessarily a good thing? No, it could mean that the car has engine problems, or that it's not, that hasn't gone through a CPO process, or that there hasn't been a proper inspection done, or maybe there has been an inspection done, and the used dealer is trying to hide something from you, and that's why it's priced so low on the sticker. So a low sticker price sometimes can be a bargain, right? Sometimes you are getting a bargain. Sometimes you are getting a deal. You're like, oh my God, I got this car for a steal. But sometimes it could mean that the engine has a problem, or that there's an accident history that you don't know about, or whatever the case is, right? So a low sticker price is not always a good thing. And there are a lot of low sticker prices in the market. And for many of those businesses, the low sticker price is not a call to action. The low sticker price is a warning, right? On those businesses. When you see really, really cheap stocks and you're like, how is this so cheap? A lot of times there's a reason. I've come across in my research sometimes, like I'll be researching an industry and I'll come across a stock and I'll be like, what? They're trading at a crazy good valuation. And I try to figure out why. And I find out, oh, not only is the business shrinking, but, one of their biggest customers maybe is on the verge of moving to another provider. Or one of their other competitors has emerged with a new product that is competitive to their core offering. Or maybe there's a ton of debt on the balance sheet. And, when you look at it just on a superficial 30,000-foot view, it looks cheap. And then you look at the balance sheet and you're like, oh my God, they're debt laden. They have twice their market cap in debt. So any number of things can be the reason why a stock is cheap. And sometimes that reason will deter you from the cheapness and say, okay, I know it's cheap, but I don't want to deal with that. I don't want to deal with the debt or the failing product set or this new competitor that's arise. So even though it is cheap, I'm not going to buy it because of these other factors. So that's a very important concept to understand about cheapness. Now, when multiples are low, why can they be low? Well, earnings could be inflated, which means the company could be peaking cyclically, right? Or the margin boost they're seeing could be short-lived. The earnings could be low quality, which means that have aggressive adjustments or accounting gains or whatever, when you see these companies try to sort of pump their adjusted EPS, or, whatever the case may be, where they have very, very creative accounting methods to try to supplant the earnings report. It could be that earnings are structurally at risk. What I talked about earlier, competition, regulation, substitution by a new competitor or by any of their major customers or major partners, substituting them for another company. Or there could be straight up plain old balance sheet risk, right? What we talked about earlier with debt, leverage, refinancing risk, et cetera. So, I mean, those are just four examples, but there could be any given number of reasons why a company's multiple could be low. And so the market's setting price based on all of these expectations combined, right? All of these factors combined. It's not just about what the company's earning versus what they're going to grow. That's not the only factors involved. It's all of these different contextual factors that play a role. So your job right, or my job or our job as investors is to decide whether the expectations that are being communicated by the price, right? All the points I just made was to say that expectations are being communicated by the price that you're seeing on the stock, the multiple you're seeing on the stock, right? Your job is to decide, are those expectations that you're seeing via price too pessimistic or are they too optimistic? And if you think they're too optimistic, then you think that stock's a short. If you think they're too pessimistic, then you think that stock is not necessarily a value stock. These terms get abused. Value investor, gross investor. These terms get very much abused. I'm just an investor. I don't consider myself like, sure, I guess historically I've invested in more growthy companies, but I just consider myself an investor. So your job as an investor is to say, are those expectations for the company implied by the price too optimistic or too pessimistic? If they're too pessimistic, you think the stock is cheap. If they're too optimistic, you think the stock is expensive. That's in a nutshell what you're looking for. Now, what are you valuing when you're valuing a business? Well, you're valuing the sum of future cash flows, right? And the risk of receiving those cash flows. That's what you're valuing essentially. That's what matters at the end of the day, right? Like what is this business going to produce in terms of actual cash flow over time? And what is the actual risk that those cash flow projections or the cadence of growth of those cash flows is going to slow or moderate, right? And basically the financial statements operate as an ecosystem around that you're basically obligated to analyze, right? The income statement, which is going to show you profitability, right? It's going to show you revenue, gross profit, operating income, net income, right? Then you have a balance sheet, which is going to show you the resources available to the company, right? It's going to show you assets, liabilities, equity, right? It's also going to show you the obligations available to the company, right? The debt as well. And then you're gonna look at the cash flow statement. And that's where you're gonna see where the cash that they did generate, where it went, right? Did it go to the CFO? Did it go to CapEx? Did it go to financing? Did it go to other bridges to more free cash flow? Did it go to investment opportunities? Where did the cash go that they did generate? Okay. So you're gonna look at the income statement, the balance sheet, and the cash flow statement. And as a whole, those should give you a picture of your view on the future cash flows, of your view on the realisticness and the risk to those future cash flows. Okay. And what you should start with before you look at any of those statements, you start with two simple questions. Okay. Because this is going to give you perspective on the the likelihood that the business is going to succeed. And the two questions you should ask yourself before looking at any of those income statements are, what do they sell? What's the product? Right? Who are they selling it to? And why are customers picking their product? Right? And that third question is often a very, very hard, or that third component of that question is very, very difficult because you need to do research to figure that out. You need to understand the product set in the industry, what other competitive products are out there, and why their product might be being chosen by customers. And sometimes it'll be specific to the customers that are buying from them. You might have 10 major customers in an industry, and maybe two of them are going to this company. And it's your job to figure out why those two specifically are going to that company. What is it about their product that attracts those companies? And so that can be a little bit more complicated, a little bit more nuanced. But again, if you want to understand the company, you have to learn how to answer those questions and do the research to answer those questions. And the beautiful thing about AI is you can just ask AI that, and then deep dive the portions of the answer that you don't understand. And so AI has really simplified research like that. Back in the day, I mean, 5 years ago, I would just have to manually figure that out on Google. And it was a much, much longer process, right? Of trying to compare product sets between two or three companies in an industry, especially when you're looking at smaller companies, and trying to distinguish them can be very difficult. And so that's one question you should ask. What do they sell? Who do they sell it to? And why are they buying? And then what is the competitive advantage that the company has? Are there any competitive advantages in the business and the strategy and the management team and the technology moats? Are there anything that is just driving moat or market share for the company? And then after you answer those two questions, what do they sell? Who do they sell? Why do they sell it? What are the competitive advantages? Then you can look at the income statement, the balance sheet, and the cash flow statement, because then you'll have context to understand what you're seeing in those statements. Because otherwise, you're just looking at a bunch of numbers, right? Then you could, without the context, you could be comparing a online marketplace for cars to a high moat cybersecurity business. And you won't know the difference because you're just looking at a bunch of numbers on a balance sheet. You have to know the context before you look at the financial statements. That is super, super critically important. And I know many people who do not do that, who just go straight to the balance sheet. And that is a that's a dangerous thing to do because what's going to end up happening is you're going to go to the balance sheet, you're going to find something that you think is cheap, and then you're going to go and try to backwards justify it with the context, right? And so you're already setting yourself up for analytical failure there by not developing context before you look at the income statement. So that's super important to do. Now, how do you put your thumb on actual valuation? There's three basic methods, okay? There's something called discounted fat cash flows, DCF models, which I'm sure you guys have heard of. Now, I'm not going to teach you how to build a DCF model today. What I will tell you is some AI models are pretty decent at it. I think GPT Pro is decent at it. Not amazing, but decent. Claude's okay at it as well. Gemini's okay at it as well. The purpose of a discounted cash flow, DCF model, intrinsic valuation is what some people call it, is to forecast free cash flow. Okay, not just earnings, but forecast free cash flow over a period of time. Okay. And you're going to need to choose a discount rate. You're going to need to add a terminal value. You're going to need to defend that terminal value. And so it's not something you have to know how to do, but it can be a useful tool. Okay. The other sort of concept in valuation toolkitting is relative valuation. Now, this is much simpler than DCF models or any kind of models. And relative valuation is very simple. What you do is you identify the industry you're in, right? You find I like to find three to five, maybe more, depending on the industry, companies that are very similar to the company you're analyzing. Okay. Similar business metrics, similar products, similar businesses, period. Right. And what you want to do is you want to adjust for differences in things like growth rate, margin, and that can be gross, operating net margins, right? Whenever this is another just quick tidbit. I'll throw in a lot of tidbits here along the way, and feel free to take notes if you want. As always, this is recorded. But one thing I do whenever I'm looking at any company is I like to know all three margins across the board, gross, operating, net. I want to see how it flows through to the bottom of the balance sheet. I don't want to just know the gross margin of the business, right? That can be very misleading. You might have a company that's doing great gross margins and their operating and net margins are just not there. And so I like to know all three of those. So whenever I'm doing my sort of fundamental breakdowns with AI or even just on Google or whatever, I'm always looking at all three of those. Just by the way, gross, operating, and net margins. But you want to adjust for the difference in growth, gross, operating, net margins, and that can be, by the way, on the growth side, top and bottom line growth. Risks to the company, capital intensity, leverage. How much money are they spending a quarter? What does their burn look like? What's the sustainability of their debt? Right? You want to look at all those factors, but from a top-down view, 30,000-foot view, you really just want to compare on relative valuation. Hey, if I'm looking at five companies in an industry and one's trading at 20p, one's trading at an 18p, one's trading at a 36p, one's trading at a 12p, one's trading at a 20p, you don't want to just look at them all on the list and say, this one's the cheapest, this one's the most expensive. That's childish. Okay. And that's rudimentary. You're not going to learn anything from that. What you want to do is understand all those companies, right? Let's say there's five companies on the list. Get a basic understanding of what they all do, what they sell, right? Um, and then ask yourself why the valuations are different. And where you will find relative peer value, when you'll find something with a compelling peer value is when you say, "Oh, this one is trading at a significant discount to the peers, but I don't see a good reason for why." I think the business is excellent. I think the products are competitive. I think they're showing good growth. They should not be trading at this much of a discount to peers. And that's one of my favorite ways to find stocks that I think are cheap. Okay, is relative valuation to peers. You'll see me reference this a lot. If you go through like my theses on stocks, I reference this quite a bit and saying, hey, it's cheap relative to peers. Even with trades that I make, like I remember with Dragonfly, I didn't do much of a valuation analysis on Dragonfly. I mean, it's not a big company, but I traded that three times now successfully in the last 6 months or so, and it was always on the idea of, hey, relative to the peers, it is a very, very cheap valuation. And I've done this with many stocks that I've looked at. I mean, everything from even last year when we were looking at NTCT, which just had a great report. I just talked about that today on Spaces. That compared to the cybersecurity industry, very good valuation. When I was looking at Amcor, right? When we first got into Amcor last year, same thing. Inersis Systems, ENS, same thing. Viavi, same thing. Like all of these were cheap versus the peers, right? When I looked at them, when I looked at them. And that matters. That's compelling to me. When I see a company that is trading at a discount to its peers and it doesn't have a good reason to, that is a very, very important conclusion to make. So outside of your intrinsic valuation, your discounted cash flow model, relative valuation is an important one too. Another thing you can look at, and this is the third method in the sort of toolkit, is asset-based valuation. Now, asset-based valuation is really like when you're looking at a company objectively, just on what they own and what the liabilities are, right? So what's the liquidation value? What's the replacement value of the assets? What's the net asset value? NAV. Some of you have heard that term, especially you SPAC people. You've heard the NAV term a lot, right? Net asset value. So you're looking at those metrics, some of the parts valuation. I'm sure some of you have heard that term, right? That all that stuff is relevant to asset-based valuation, right? And so that's most useful when the assets are easily separatable. Okay, when it's not a big amalgamation of factory and a bunch of shit sitting in a factory, when the assets are easily distinguishable from one another, right? Maybe you have a site here in Tennessee and you have a site in Texas and you have X amount of asset value in those sites. You can easily separate them. They don't have a lot of interconnection. When you can easily separate the assets and mark them separately and mark them relatively close to reality, that's when that type of valuation becomes the most reasonable, most useful. Sorry. So you can do an intrinsic valuation, aka DCF. You can do a peer valuation, relative valuation to peers, which is my favorite way to look at valuation. Or you can do an asset-based valuation, which is just talking about what they own and what they owe and what the net value of their assets are, right? A lot of the guys who invest in bankruptcies or who invest in buyouts and these kind of things, they're looking at asset-based valuation. They want to know what's there, what's left, right? What hard tangible assets can I assign value to? So to get a really comprehensive view on valuation, you should look at all three. If you really, really care about getting a comprehensive view on value, you should look at all three: an intrinsic DCF model, a relative valuation, and an asset-based valuation. Now, is it necessary to do that for the purposes of every trade? No, it's not. I'd be lying to you if I said I did a DCF for every stock I've ever owned. I have not. In fact, there have been many, many stocks that I've owned that have not ever come close to doing a DCF. Or maybe at best, maybe I punched it into an LLM to make me a basic discounted cash flow model. So you don't need to do all of the work on your own, but it is important to have a grasp, at least in all three of those categories, of what future cash flows might look like, what the valuation is relative to peers, and what the assets are worth, and what the debt is. You should know those three things generally. Okay. Um, at least superficially. So, bottom line from that little snapshot of those three toolkits, you can value a company on what cash flow it'll have, what similar businesses are valued at, or what the pieces of the company are worth if they were separated and sold. That's how you find out what a company's worth. Those are the three basic fundamental ways. Okay. All right. Now, what should you look for on a balance sheet? Okay. This is a question that a lot of you ask sometimes, and we'll go over things to look for. Okay. First thing I'll look for is liquidity. Okay. What are the cash and equivalents? What are the current assets versus current liabilities? What's the total debt? You want to make sure the company's in a liquid situation. You don't want to make sure their back's not against the wall from debt load, right? You want to make sure the total debt, net debt, debt maturity schedule, ability to finance that debt, ability, to not have an insane amount of cash burn relative to that debt. You want to know that the financial picture in general, the liquidity is intact. You want to know if there's any refinancing risk. Are there any near-term loan maturities coming up? Is there, potential for equity dilution or distress? If the company's burning a lot of money and has a low cash balance, what does that mean? I mean, you don't have to be rocket science to figure it out. It probably means they need to raise money, right? And it probably means you're going to see some equity dilution. You're going to see, them sell stock to raise cash, most likely, right? Not always, but you want to know the probabilities of these things of happening, right? And if you have a company that's burning a lot of cash, low on net cash, you have to expect that. You have to be like, hey, look, there could be an offering next week. You have to be okay with that. You want to look at leverage metrics, things like net debt over EBITDA. You can look at debt versus equity. That's a very, very common one. That is context dependent, though, debt versus equity. Sometimes you'll see a company with debt, but the debt will be operating debt, right? It'll be debt that's necessary, required to operate. An example of this is GXO, which we looked at last year, which was a transport logistics company, which I still like. We don't own, I don't own it anymore. But when I wrote my thesis on it, what you might remember is that I talked about the debt, and I said, look, I know the debt can look concerning on face value, but almost all of the debt is operating debt, which means that it's tied directly to revenue, right? So that's what I mean when I say debt can be context dependent because you have to know why they have the debt. If they just have it to have it, then yeah, that could be concerning. But if they have it because it's required for them to conduct operations, that's different. If a company's coming to you, like for example, in GXO's case, they were opening a warehouse for Nike. Nike comes to them and says, hey, look, we're going to pay you over these 5 years to build and operate this warehouse for us, right? The debt they take on to fulfill that Nike contract is operating debt, right? That money is already signed over by Nike over 5 years. So if they are taking, let's say I'm just throwing numbers out here. Let's say the contract's worth $200 million per year, okay? And if you're taking on $20 million in debt incrementally per year to service that contract, is it bad debt? No. You're using $20 million to generate $80 million net. So no, it's not bad debt. But that's context dependent. You wouldn't know that if you didn't understand the business. You see what I'm saying? You would just look at the balance sheet and go, well, screw that. They have a ton of debt, rather than understanding that the debt is coming from an operating perspective. So you have to understand that context. Just like everything else, a debt is context dependent. So you have to look into that. Interest coverage. You want to know how are they able to cover the interest on their debt? Okay. You want to know if there's any off balance sheet or hidden obligations. Okay. Sometimes you can hide things like leases, pensions, legal contingencies. If there's like some kind of legal proceedings going on, you can hide those things off balance sheet. You want to dig around and make sure there's no hidden obligations off the balance sheet. You want to know what the share count trend is. This is an interesting one that not a lot of people look at. Okay. Share count trend. What is that? That's basically a map. You can look this up. You can ask your LLM to build you one for you. Say, build me a share count trend map for whatever stock you want. It'll show you dilution via SBC, SBC being stock-based comp. Many of you know this. It's a huge problem for a lot of companies, especially software companies. But you want to look at what the dilution is versus stock-based comp and equity raises, right? Because both of those things are dilutive. You want to look at the stock-based comp, look at the equity raises, and say, what's the share count trend over time? Is this a company that's a tendency to dilute perpetually, or is it a company that's really relatively disciplined with their share count dilution? So all those metrics, liquidity, debt load, refinancing risk, leverage, ability to cover interest, any off-balance sheet intangibles, share count trend. In other words, you don't want to look at, oh, they raised money last quarter, so they're terrible. No, what's the trend? Over the last 3 or 5 years, what tendency do they have to dilute the stock and to issue stock-based comp? If they did it 1 quarter, okay, that's fine. Companies raise all the time. You have to know, why did they raise? What are they using the capital for? Are they going to do it again? Are they doing it just to do it, just to make the executives rich? Or are they doing it with purpose, right? You want to see share dilution with purpose, right? That's why a lot of times when a company will do a raise, the first thing I do is I go look at the description of what they're spending it on. What are you spending it on? If you're just diluting to dilute, then screw you. But if you're diluting and you're like, oh, we're investing in this new product suite that's going to bring a lot of growth, great, great. I want to see that. So not all raises are bad. Not all equity raises are bad. Okay, some people think, oh, they did an offering, they must be a terrible company. No, 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 no. If they have some big contract coming up and they need another incremental $300 million of capital, they have to raise. What do you want them to not fulfill the contract? That'd be insane, right? So again, this is where a lot of the knowledge of the company comes into these objective factors with the balance sheet I'm talking about. You can't just look at a balance sheet and be like, I figured it out. That's not how it works. You have to understand the company, why they're raising debt, what their operating liabilities are, what their obligations are, why. Ask yourself the why question constantly when you're doing fundamental analysis. Ask yourself why constantly. Why? Oh, there's debt there. Why? Why is the debt there? Why is the debt so high? What sort of debt is it? Like, ask the questions. Asking questions is the quickest way to get smart in stocks. Asking yourself questions. Not necessarily asking somebody else, but asking yourself questions and then going and finding out those answers to those questions yourselves is one of the quickest ways to develop comprehensive knowledge about the markets. Um, okay, let's talk about valuation metrics a little bit because I've gotten this question too. So, how do you choose which metric to look at versus like P, price to free cash flow, EV over EBITDA, EV over ARR, et cetera? How do you figure that out? Well, that's a pretty complex question. Now, when you want to measure the value of equity directly, okay, the equity in the company directly, you're probably going to lean to things like price to equity, price to free cash flow, price to earnings, price to free cash flow, PE being price to earnings, P to FCF being price to free cash flow. That's generally what you want to look at. You can also look at something like price to book. That's when you want to determine the value of the equity directly. Now, when you have a more complex company where the capital structure is going to differ a lot from peer to peer in an industry, then you want to get a little bit more nuanced. And you can look at things like EV over EBITDA. In software, for example, EV over sales is often used, or even price to sales sometimes, depending on how leveraged the company is. ARR is used pretty frequently, for example, in software. Um, so you want to be careful about looking at raw metrics when you're looking at industries that have very complicated capital structure or industries where the capital structure is varying a lot from peer to peer. The debt structure and the cash flow structure is varying a lot from peer to peer. Now, keep in mind with EV, the reason EV has a little bit more nuance is because EV is going to give you the market cap plus the total debt plus preferred equity, right? So, and minus cash. So, if you have a ton of cash and no debt, the EV is going to be lower than your market cap. If you have a ton of debt and little to no cash, the EV is going to be higher than your market cap. And so that kind of gives you a little bit more perspective on how the capital structure might play a role in valuation. So a lot of people like to look at EV over EBITDA because it just wraps that into the equation for you, right? It wraps the debt and leverage into the equation for you. So I like to look at all of them when I'm looking at a company, and again, I'm going to put less weight on some over the others depending on the type of company it is. But in order to really know what you need to use, you have to look at the details of the company, the details of the industry, and how the capital structure might vary from company to company. So the short answer is it depends. And it would probably take me a whole workshop if we might do another one actually just on that topic because it's a very, very complex topic as to when to use which valuation metrics and why you should use them. So if you guys have questions about that over the next few weeks as you explore that, you can ask me directly, but we might do a topic on that, a workshop on that specifically, because that'll take me an hour to go over all the different cases of valuation metrics and when or why you should use them. But understand that every one of those metrics has a different adjustment that they're making. And what you want to know is the context behind the adjustment. Every adjustment made in a metrics is a choice, right? So understand what am I hiding and what am I revealing when you're picking any of those things? PE, price to sales, price to free cash flow, EV over EBITDA, right? Like when you're picking price to sales, what are you doing? You're hiding the profitability metrics, right? You could have a really attractive price to sales. You could have a company that's burning cash out the wazoo, right? But maybe they have an attractive price to sales. But you have to understand what am I hiding by looking at that metric? That's the big factor. When you want to differentiate different metrics for valuation, you ask yourself, what are they hiding versus what are they showing, right? Like your price of free cash flow, it might, you know, be really attractive to you on a certain stock, but it may not give you a full perspective on the business's ability to grow, right? For a really fast growing young business, is price to free cash flow the right metric to use? Of course not. Of course not. Because you're not expecting that business to generate free cash flow yet, right? If a business is growing 60% year over year, right? And it's in a really niche high tech industry, and you're looking at price of free cash flow, you're not going to figure anything out. Price of free cash flow is going to suck. And then you're going to get deterred from the stock and be like, it's not a good stock. And then you're going to watch it double in front of you because, again, you're not contextualizing the metric. You have to contextualize everything. It's not as easy as just looking at the balance sheet. So for a business like that, you might want to look at price to sales instead for a young growing business like that, right? Or you might want to look at um, you know, uh, uh, the growth metric, the ARR growth metric over a certain period of time. If it's a software business, for example, a young growing software business, look at how quickly is ARR growing. What's the net retention look like, right, on a year-over-year basis? So understanding the business is the biggest key to knowing how I begin to analyze it because every metric hides something and shows something else. And knowing what's hidden and shown is how you're going to figure out what's useful and what's not useful. So, um, like I said, P can be very useful when a company's consistently profitable, when the margins are relatively stable, when the leverage is not extreme. But P can be a very bad metric when you're looking at cyclicals, for example. Okay. So this is a concept that sometimes is hard for people to understand. But when you're looking at cyclicals, so a company that has a cyclical business, right? They have periods of seasonal strength, periods of seasonal weakness, things like automobiles, semiconductors, commodities of all sorts. Low PE can be a mirage, can be a misleading factor because it can show you a cheap PE when a cyclical company is at peak earnings for the cycle, right? So when a cyclical company hits peak earnings, right, what's going to happen to the PE ratio? It's going to look low. You're going to look at it and be like, what the hell? It's trading at a 16p. Like, I have to buy this thing. But what you are lacking again in the context, which is where everyone misses everything is the context. What you miss in the context there is, but their earnings are about to peak, right? And so then the stock, what's going to happen? You buy a cyclical top peak earnings, what's going to happen? Earnings drop off, and then you're buying it, the stock literally at the peak. You're buying it at the lowest PE, but the highest price, right? And so this is the reason I'm bringing up this caution about PE. It's just an example I'm bringing up is to show you that all these metrics have downsides. You can't just use PE for everything and just dance around and say, I'm a PE hero. That's not how it works. For certain industries and for certain companies, it's going to be misleading. And, outside of cyclicals, you can look at companies with meaningful one-time items, right? That can obscure EPS. I'm sure you guys have seen this where you see a company post a huge EPS beat, right? They post a 300% EPS beat, like, what the hell happened? And they have some kind of meaningful one-time item or restructuring or an accounting gain or loss, something that happened that quarter, a meaningful event that just ripped their PE through the roof or maybe dumped it. And, people over focus on that and misinterpret it and dump the stock or rip the stock on it and not understand why, right? And also companies with heavy dilution or heavy stock-based comp, their earnings might underestimate the cost. And so those can also obscure PE. So there's a lot of scenarios where the metric can be misleading to you. A cheap PE can be misleading to you. So be careful about that. Um, Okay, what about price to sales or EV over sales? So, price to sales, EV over sales, when are they useful? When a company is volatile, right? When a company is young, when it's an early stage, like I mentioned earlier, when it's in a low margin sector. Low margin sectors like actually is tends to be very relevant. Even for some of these packaging OSATs, like when I was looking at Amcor, for example, I was looking at the price to sales. Now I care about the PE, I care about the margins, I want to see them expand, but I was looking at the price to sales at that time because again, it's a relatively low margin business, and I want to see how quickly their ability to capture market share is growing. If you're more focused on market share capture, you do care more about the sales, right? Now, where can it be misleading? Well, like always, it can be misleading because what if they're getting the sales inorganically? What if they're buying the growth in their sales? Well, that's not necessarily as good as if their organic core business is growing, right? So that's a distinction you have to make. You also want to know, look, if margins are terrible or getting worse, that's really a red flag. Margins getting worse as those sales grow, then you really want to ask yourself why. Is this company going to be able to be a profitable entity when they have reached peak sales, right? And are they going to be able to reinvest in the way to do so, reinvest in infrastructure and logistics in a way where they can do so? So that's an important factor to be considered too, right? And let's look at free cash flow a little bit too. So what is free cash flow? Free cash flow is money that can pay debt down, it can pay out dividends, it can conduct buybacks, and it can be used as reinvestment for growth, right? That's what cash flow can do. Now, when do you want to use price to free cash flow? Well, you want to use it. Remember, like what I said earlier, you don't want to use it for young growing business. You want to use it for mature businesses, and you want to use it for cash generators. You want to use it for businesses where CapEx is relatively stable. Okay. So when you have businesses like that, then you should be looking at free cash flow. Once a business has been around for a while, they're a mature competitor in their field. They're not necessarily trying to capture incremental market share. They've built positioning in their field. That's when that metric can be useful. And how some people like to frame price free cash flow is they like to use free cash flow yield. Okay. What free cash flow yield is just free cash flow over EV. Okay. And over enterprise value. And sometimes you can use free cash flow over market cap, depending on what kind of free cash flow yield metrics you're looking at. Same thing, basically. Free cash flow over EV, free cash flow over market cap, essentially the same thing. And so what you want to do is you want to compare your free cash flow yield in these instances to other mature peers. So you could look at your free cash flow yield for a particular company and then look at other companies in that same sector and ask, what are their free cash flow yield? And another thing you can do is look at free cash flow yield trend for a company. Like earlier, we were talking about looking at trends in certain metrics. You can look at free cash flow yield trend for a certain company over a certain period of time and ask yourself, is this a positive trend in free cash flow yield over time? I'm sorry, one second, I got a message here. Okay, sorry. Anyway, okay, so EV over EBITDA next. So EV over EBITDA. What does EV over EBITDA do? Well, it lets you compare companies with different levels of leverage. Like I said, different capital structures, right? It gives you a perspective on capital structure. So some people like to call it capital structure neutral, but you have to be careful. It's not foolproof, right? Um, you want to use EV over EBITDA when CapEx is relatively stable, like I said, but also when there is a capital intensive business where depreciation is not equal to true maintenance CapEx, you do not want to use it in those cases. Okay. So highly capital intensive businesses, it's not going to be a very useful metric. And businesses who have negative or tiny amounts of EBITDA, you're obviously not going to find it useful there either, right? And then with ARR, EV over ARR, EV over revenue, like I talked about, those are the type of subscription style businesses you want to be looking at. Businesses with recurring revenue, retention rates, unit economics, very predictable growth. Those are the types of businesses where you want to use metrics like EV over ARR or net retention rate and things like that. So what is cheap historically? This is the next note I have. This is a funny one. Okay, so S&P 500 trailing P roughly 15 to 16 would be considered historically very cheap, right? In the current market, 19 to 20 probably would be considered cheap. But you have to understand that over time, these metrics change, right? And that's what makes historical valuation metrics, in my view, unreliable, right? Like you'll see people on Twitter a lot of the times look at historical PE and say like the market is expensive relative to historical levels. You have to factor in a lot of things when you're thinking about that, right? You have to factor in the fact that participation in the market has increased dramatically, right? There's far more participants than there were. Accessibility to the market has increased dramatically. Um, overall, the biggest companies in the world have become much more profitable than they were, especially when you go back to like the dot-com era. And so markets have changed and expectations about markets have changed. The participants in markets have changed. Their time horizons have changed. Retail is a bigger participator than ever before. They have a very, very different time horizon and perspective on markets than the institutional entities. And so I don't find looking at historical PE in the SP 500 is a particularly useful thing. And I don't find it to be something that you guys should really spend a ton of time, you know, peering over. I have a couple more notes here that I want to touch on before we move on to questions. So give me a second. I already covered that. Okay, so I want to go over two things. First, I want to go over 10 metrics for valuation dashboard, and then I want to go over the is it cheap checklist to kind of contextualize all the stuff I just went over. So take notes on this if you want, but as always, it'll be recorded. So we'll do that. And I'll do a little bit of a top-down summary of everything I just went over, and then we will do some charts really quickly. We're gonna like burn through 5 or 10 charts really quickly, and then we'll probably wrap things up after that. But um, yeah, this is what we'll do. Okay, so let's do. I like to call this a dashboard, but you can call it whatever you want. This is just 10 metrics that I think you should look at for every company you're looking at. Okay, so number one, revenue growth, top and bottom line. So revenue growth and earnings growth. So EPS growth, revenue growth over X period of time. I like to look at it over a 5-year trend. In fact, I look at it probably over a 10-year trend, but I focus on the 5-year trend. So I'll get a general snapshot of the 10-year trend, revenue growth, EPS growth, then I'll narrow it down to five, and then I'll really hone in on the last 3 years, and then I'll also look at the year-over-year metrics. So year over year, get a 3-year window where you hone in on, 5-year perspective, 10-year, just get a glance. But again, it depends on the type of company and how long they've been public, how much of their history you want to look at. But you want to look at top and bottom line growth. That's point one. Point two, you want to look at gross, operating, and net margins. Okay. Point three, you want to look at free cash flow or free cash flow margin, free cash flow yield. Okay. Point four, you want to look at return on invested capital, ROIC. For banks, it's going to be ROE. Okay. Point five, you want to look at leverage, net debt over EBITDA. You can look at leverage in any number of ways, debt ratios, debt to equity ratio, but you want to look at leverage. Point six, you want to look at their ability to cover interest coverage. You can look at EBIT over interest expense, EBITDA over interest expense, free cash flow over interest expense, whatever. You want to make sure the company's able to handle the interest they have on their debt. Point seven, you want to look at liquidity. So you can look at current ratio, quick ratio, free cash flow. You want to basically develop an idea of what the company's runway is. And then point seven, you want to look at share count trend and stock-based comp trend, which I talked about earlier. Once you've looked at those things, you have a pretty good idea of what the company is looks like financial health wise. Okay. And then with your is it cheap checklist, you want to look at a couple of things. First, you want to pick the right valuation lens. If profitability is stable and there could be some differences in leverage structure, you want to look at things like P, EV over EBITDA, free cash flow yield. If profitability is not a meaningful factor yet, they're a young company, they're growing, you don't want to look at those ones. You want to look at things like EV over sales, EV over gross profit, EV over ARR, whatever. You want to look at something that shows you the growth side, the top line side, and not the bottom line side if they're a young company and they're not profitable. If they're financial, you're going to look at things like price to book, right? Or ROE. So that's pretty simple right there. If the company's mature, stable, you look at your PE and your EV over EBITDA and your free cash flow yield. If the company's not profitable yet, young and growing, you want to look at things like EV over sales, price to sales, EV over ARR. And if they're financial, you want to look at price to book or ROE. Simple. Now, step B. What are you going to do after you pick your metrics? Well, you're going to normalize them. Okay. So you're going to look at the metrics across the same quarters. If a company just reported earnings and another peer of theirs hasn't reported the earnings yet, you can't compare them. You got to go back. You got to go back in time and go to the last quarter and start there. Right? You have to normalize the comparison metrics. So you have to do that. That's step B. Take out the one-offs, one-off charges, anything that could be obscuring the view. But you have to normalize the comparison. And then step C, you want to compare in all the metrics we talked about versus the company's own history, right? Are they growing relatively well compared to their own history against their peers, right? So the other companies that are like them in the industry, and then also against their own fundamentals, which is like your DCF model, your intrinsic valuation, the stuff we talked about in the earlier part of the session. So you got to compare it against all three of those metrics, all three of those vortexes. So that's step three. And then step four, you want to look at do you require any adjustments here? Is there anything you're missing or any risks that you want to factor in for the company? You want to take note of those because you don't want to just have this confirmation bias driven opinion, right? And so in after you've decided what the risks are, you want to identify if the risk explains the discount, right? So let's say you figure out through the first three steps the company's cheap in your view. Okay. In these last steps, what you're doing is there a reason for it to be cheap? Have the risks I've identified justify its cheapness? And if you say no, then it's a buy. Then you think that the risks are not properly accommodating for why the stock is cheap, and then the stock is undervalued in your perspective. And so you want to decide if you're being paid for the risks in that low multiple, right? And if you think a stock has a lot of risk and the multiple is high, you're not being paid for the risk. And the opposite is true, right? And it's not a stock you should buy. So those are important. But a stock is cheap, generally speaking, when the earnings are real, you know that they're sustainable, you know there's no major risk that they'll fall off a cliff. The balance sheet won't kill you. In other words, the leverage is fine, the cash burn is fine, the debt is fine, the ability to pay for those things, free cash flow is there. The multiple fits the business model, right? That's important. You don't want to be paying a 30, 40, 50 PE for a non-tech company, right? That's growing relatively modestly. You have to understand that technology, these companies that are fast growing should have higher multiples and are supposed to. You don't want to go pay a 50 PE for an industrial, right? So the multiple has to fit the business model. And then also you want to make sure it's actually cheap versus history and versus peers. So it's cheap relative to its own history and relative to its peers. That is a critical point. I've said that a few times but that's a critical point. And to me, that's where most of the insight comes from. Cheap versus history and cheap versus peers. And then you want to make sure that all the risks that you've identified are embedded in the valuation in your favor. Right. So yeah, that's kind of a pretty all over the place, but pretty comprehensive summary of how I think about valuation and how I think about these metrics. Now, a couple of summarizing statements I'll make here about it. Now, keep in mind a stock is cheap only when its price is low relative to your perceived underlying value. Okay? Cheap equals price is low relative to my perceived underlying value based on my analysis. Not just when the price has gone down a lot. Just because a stock is down 50% in 2 weeks, the price action has nothing to do with the cheapness. There's another stupid thing I see on Twitter a lot. The stock's down 50%. It's so cheap. I must buy it. It means nothing. It means nothing that how much a stock is down or up. All that matters is what the valuation is. There are expensive stocks that can go down 50% and still be expensive. There's stocks today that are trading at 200 PE and 70 times sales. Like, is that stock expensive if it goes down 50%? Probably. It's probably still expensive. It goes down from a 200 P to 100 P. Is it expensive? Yeah. So it's not about how much a stock has gone down. It's about price relative to your perceived value at a given time, right? And at the end of the day, these multiples we talk about, P, price of free cash flow, price of sales, they're simply shorthand for the story about what the future cash flows will look like and what the risk is. That's what they are. They're just a shorthand way to tell that story, right? And so a low multiple can signal a bargain, but it can also signal deteriorating demand. It can also signal shrinking margins. It can also signal excess leverage. It can also signal low quality earnings. So cheap multiple doesn't necessarily mean a stock is cheap. And your core task is going to be separating what is temporarily unpopular from what is fundamentally impaired, right? Sometimes a stock is just temporarily unpopular, and those are your buying opportunities. What's not a buying opportunity is when a stock is actually fundamentally impaired and there's a tremendous amount of risk. Okay. That's the difference. And your job is to distinguish those two things. Okay. And what you should really categorize the term cheap as is mispriced pessimism. Okay. Mispriced pessimism. And you want to be able to defend your opinion that it's mispriced pessimism. You want to be able to defend that with evidence to say, yeah, look, the market's being pessimistic on this stock, too pessimistic, and here's why. And if you can't explain that in 4 or 5 sentences, then you have not done the work. Then you have not done proper analysis. You should be able to explain the answer to that. Somebody should be able to come up to you and say, why is it cheap? And you should be able to answer that question without citing the PE ratio. You understand what I'm saying? If somebody asks you, why is this stock in your portfolio cheap? And your answer is, well, look at the PE ratio. You didn't learn anything from this workshop, and you certainly didn't do any fundamental analysis. You should be able to answer that question in contextual detail at length for 3 or 4 sentences straight, fluidly be able to answer that question. That's when you know you've actually done the work to make that conclusion. If you have not, you won't be able to answer that question. Somebody will come up to you and ask you and be like, well, it's cheap because it has a 20 P and one of their peers has a 25 P. Okay, well, that's one small component of why you might think it's cheap, but it does not provide enough context for why you have concluded that the market has put unfair pessimism on this stock, right? Mispriced pessimism. And that's what cheapness is. So fundamental analysis starts with the understanding of the business model and then connecting it to the financial statements. Like we talked about earlier with the toolkits, the 3 toolkits that I went over, and how I said that before you even touch on those, you must understand what they do, what they sell, why they sell it, what their competitive advantages or disadvantages are versus the peers. You have to understand those things before you can start delving into the balance sheet. You have to, or else you're going to be a lost puppy looking at a bunch of numbers. Okay, so you have to understand those things first. And then you can use the right metrics and the right relative valuation, and you can look at the asset-based approaches and all that stuff when you need to. But you first must understand the business. To quickly assess financial health, you want a compact dashboard, like I talked about with those 6 or 7 metrics I went over. You want to be able to look at those metrics on a dashboard so you can, in a jiffy, in the snap of a finger, say, yeah, there's relatively good financial health here, right? The revenue growth is healthy, the margins are healthy, the free cash flow is healthy, the free cash flow yield is healthy, the return on invested capital, ROIC, is healthy. You want to look at all those metrics, the liquidity, the net leverage. I went over all these earlier. Again, it's all recorded, so you can go back and check that checklist. But you want to go over that checklist to get a snapshot of financial health. That's how you quickly assess financial health, right? And it also gives you a perspective on whether you're in a value trap or not, right? Again, a lot of times cheap stocks are cheap for a reason, And those are your value traps. And sometimes stocks are cheap and there isn't a good reason for it, right? And those are your opportunities. So that's the difference really between those two and why you should have a quick fire away list of stuff you can look at and make those assessments quickly. I mentioned this earlier, but again, PE fits stable, consistently profitable companies with predictable businesses. Price to sales or EV over sales fits companies where the earnings are not really informative right now. They're young, they're growing. And price to free cash flow and free cash flow yield are useful for mature businesses. I talked about this earlier, just reiterating that. Um, and EV over EBITDA can be useful when there's a big difference in capital structure and leverage and debt, and you want to get an unbiased view on those metrics that includes debt and includes cash levels. So peer comparison, like I said, is my favorite form of valuation comparison. I think it's the simplest and easiest form, and sometimes the most informative. You want to start with a true peer set, which means similar business models, similar margins, similar growth, similar capital intensity. When you find companies that have those similar factors in four, you found a peer. Okay? Find a couple of peers and then use your enterprise value metrics or your price to free cash flow metrics or your free cash flow yield, again, depending on the type of business it is, and start comparing them and start deep diving. And then once you've concluded, hey, on a metric basis, on an objective basis, this stock is cheap. Once you've made that conclusion, then you go find out why. Why is it cheap? And sometimes what will end up happening is you'll say, oh, I found out why it's cheap. They have this enormous client that makes up 70% of their business, and that client might leave them next year. I don't want to buy this thing. And then other times you'll say, oh my God, there's no reason to be cheap. It's the only advanced packager in the country, a la Amcor last year, right? When Amcor was trading at 1 time sales last year, I said it's very, very cheap. Amcor is now trading at 2.3 times sales, right? It's double, more than doubled. Why did I think it was cheap? Because back then it was the only, or it still is, the only packaging OSAT in the country. And I was like, it deserves premium for that. It deserves premium for being the only pure play on that topic in the United States. And so what happened? We found the premium and the stock doubled, right? So sometimes you're going to be disappointed by the context. Sometimes you're going to be really, really surprised and excited by the context. The stocks you want to buy are the ones where after you've made the conclusion that on paper they're cheap, after you've made that conclusion, you find out in the context that there's a really interesting story behind them too. Those are the best stocks. Cheap on paper, great story under the surface the market doesn't see, right? And so those are going to be the ones where you kind of raise your eyebrows and go, I need to buy that stock. And so really the conclusion is that this is about process like everything else I go over. You want to pick the metric the metric that matches the economics of your business. Whether you're a mature business, a young business, a normalized business, whatever it is, a high debt business, you want to pick the metric through all those metrics we went over, what matches the economics. Then you want to normalize the comparisons and normalize the numbers. If your company just reported earnings, you can't compare it to a company that hasn't yet. Then you want to triangulate the company 3 ways: against their own history, against the peers, and against their own intrinsic value, which again is a DCF model. What you want to figure out from there is the stock cheap or is it expensive? And why is it cheap or expensive? And your analysis is what's going to dictate that, your personal analysis and your personal understanding of the company and the business. And so, in plain terms, cheap is not just a ratio, right? It's a situation. Stock being cheap is not a number or a metric or a benchmark. It's a situation that the stock is sitting in, and it's your job to understand if the situation is optimistic or pessimistic and why it is. And when you're able to make those conclusions, that's how you will become deft at snapping your fingers and saying the stock is cheap. And for me now, I'm at the point where all of the stuff we went over, in the last hour, takes me about an hour to do on any given company. And it used to take me many hours, but now with the help of AI, it doesn't take me very long to make these conclusions. And so you want to get to the point where it takes you a half an hour or an hour to do this full top to bottom cheapness analysis. And I won't even call it fundamental analysis because really, again, the title of today's workshop is What Makes a Stock Cheap. That's really what this is about. And once you can find a stock that you think is cheap and it has a great chart and is thematically relevant, those are some of the best stock picks. And those are some of my best stock picks over the last few years too. So, um, yeah, that's what makes a stock cheap in a nutshell. Any questions on that before we go over a power chart review? I see 10 questions here. Okay. Yeah, price to book can be useful for financials. It can also be useful for asset heavy businesses in general. I mean, it's not like a bad thing to look at. Do you have a recommendation on AI models to do those valuations? I've mentioned this many times before. My favorite AI models are GPT 5.2 Pro and Gemini 3 Pro currently. Those are the ones I think are the best. Is long-term lease bad debt? It just depends. Again, it depends. You're gonna have to go look in why they have that long-term lease debt. If it's operationally related, you're saying they no longer manage the upkeep, but their net debt amount is really high now. I don't know what stock you're talking about. I can't answer that question. So you're gonna have to do your research on that stock and figure out why they have that long-term debt. The answer is it can be bad. My thoughts on panel debt. It's operationally related to their ships. I don't really have a concern about it. A lot of these shipping companies have debt like that. What is your projection range for revenue for LEU 30? I don't have a projection range for revenue for 2030. Are all these metrics public knowledge or easily accessible? Yes, they are all public knowledge and very easily accessible. You can get an LLM to generate any of them for you. If not, you can go to Yahoo Finance, FinViz, any number of free resources will do this. There's no special subscription required for any of the information that I discussed. I see somebody raising their hand in Zoom. Don't do that. Just go to chat and ask their question there or in questions channel. I know much of this is self-taught. But what advice would you give a college student that wants to focus on their studies on this area? You learn accounting or learn finance. Although I don't think those are particularly good fields to be in, to be honest, because AI is just going to replace a lot of that, in my view. I think AI will replace most accounting in the near future. But if you want to learn it, I mean, accounting and finance will probably teach you it best in terms of the stuff that we talked about today. I see that you're staying away from popular retail stocks simply because you don't like those companies. I don't know. We're 3 years into a historic bull market. All those stocks are trading at like 100 times sales. I'm just not interested in owning them. I mean, like that's for the herd, in my opinion. Like there are better ways to make money in markets than buying retail meme stocks. Everyone thinks that that's like the best way to make money in markets. I completely disagree. I make money much more consistently and outperform the vast majority of those meme stock traders. Like my portfolio performance is better than most of them, if not all of them. And I trade good stocks instead. So I'm just not interested. It's just not my MO. How do you use backlog in the valuation analysis? Backlog isn't necessarily demand they can meet. Yeah, backlog isn't guaranteed demand. It's just backlog. Backlog can be very misleading too. A lot of people look at backlog and go, "Oh, I'm in a $1 billion stock that has a $2 billion backlog. It must be undervalued." Like, no, unless they can meet those obligations or meet that business. I mean, sometimes you don't have the scale to meet it. You have to know. Again, goes back to context. People. You know what's funny is almost every question that I'm asked that's broad. My answer to them is I need more context. And it's a disappointing answer to newbies. You know why? Because newbies don't want to do work. Everything wants Everybody wants everything fed to them on a silver platter and no one wants to do work. So that's why people hate hearing, well, it depends. It depends on the context. But the answer to that question is it depends on the context. Um, so yeah, you have to know why those things are happening. You know, like you were asking earlier about the long-term debt. Why does this company have long-term debt? Is it healthy? I don't know. Go find out. Go find out what sort of debt it is, why they have it, why they still have it on the balance sheet. If they're not servicing the warehouses, why do they have the debt still? Find out, and then you'll know. Then you'll know if it's bad debt or not, right? You don't have to ask me. Go find out. Um, what do you use for your dashboard? I don't know what that means. I guess you're referring to like the term dashboard I reference. I just meant like having a list of stuff that you reference. I didn't mean like an actual dashboard. You mind sharing AI prompts for analysis? That's too broad of a question. I don't know what that means. And no, I don't reveal all my secrets about AI either because obviously there are, you know, if I just have everybody on AIs doing the exact thing I do, then that would be pretty um conquering of my edge. What does the frame hanging on your wall say? Oh, I guess you can't read it because it's backward. It's an F. Scott Fitzgerald quote. It says, "For what it's worth, it's never too late, or in my case, too early, to be whoever you want to be. There's no time limit. Start whenever you want. You can change or stay the same. There are no rules to this thing. We can make the best or worst of it. I hope you make the best of it. I hope you see things that startle you. I hope you feel things that you've never felt before. I hope you meet people who have a different point of view. I hope you live a life that you're proud of. And if you're not, I hope you have the courage to start over again." That's what it says. It's an F. Scott Fitzgerald quote. It's one of my favorite quotes. If I can get this back up. There we go. I live in Dallas. So yeah. I mean, dude, for Cena, what triggered me? Go read my thesis on it. I wrote a thesis in the journal. It's a silly question. Looking at PGY, single digit forward B, 25% growth. The market seems to be consistently wary of it as 0.8 preserves growing profitable. I understand the value. You haven't done enough work. You just looked at a bunch of random financial metrics and now you're spamming them at me, asking me for an opinion, which means that you didn't learn much from this workshop. Look at the context. Look at why the numbers are like that. Look at the debt. Look at the ability to service the debt. Look at their most recent earnings report where the stock was down 20%. Ask yourself why. Ask yourself hard questions, guys. Too many of you want to do um, 2 minutes of analysis and want to be great stock pickers. That's not going to happen. That's not going to happen. I promise you from the bottom of my heart that you are not never going to be a good stock picker by just glancing at a an earnings hub or FinViz balance sheet. Like you're not. And thinking you understand a company because you understand how quickly they're growing and what the PE is again very misleading. If LU breaks 220 monthly, is it time to revisit later? I'm finding it hard to use fundamental ratios and mostly rarity premium. In my view, that stock is all about rarity premium, yes. And obviously, this quarter was not a good quarter for them. So I expect a negative reaction. And we got one yesterday and still have one in the overnight session. So yeah, I would expect the stock to be 10 down 10%, 12% on that. But it's a volatile stock. It's a highly shorted stock. You have to be aware of that. Again, it's about knowing what you own. A lot of people buy small caps or stocks with 30% short interest and then wonder why they're volatile. I mean, of course it's going to be volatile. If you can't stomach a stock going up or down 12, 10 or 12%, you should not buy stocks that have small market caps or stocks that have high short interest. Period. End of story. You should never buy them. Yeah, fintech stocks are very hard to value, and there's this urge from a lot of fintech retail Momo investors that fintech stocks should be valued like high growth tech stocks, and they're not. Um, what made me first invest in Hood when I first got into it? Um, a lot of factors. I just thought they were going to be like the new dominator of modern secular finance. Like I just really liked what they were doing at that time, how they were executing. I felt like it was going to be difficult to beat them in the retail brokerage space. I liked how quickly they were growing. There were a lot of factors I liked, but that was a long time ago. I can't remember everything that was in my analysis back then, but there were a lot of factors that I liked about Robinhood at that time. At that time, the stock was, I believe, $11, and I bought $20 calls, 15 and $20 calls that expired a year later, a year out. And then I ended up exercising those calls, the 15s and 20s. And so then I ended up getting the stock at $19. And that was in the beginning of last year. Yeah, all of the metrics and multiples are subjective, and I always find myself changing them all the time. That's what this whole workshop was about. This entire workshop was about how you shouldn't use one metric for everything. That's what the whole workshop was about. So yes, do you resonate with the thematic approaches of some of these stocks? Like, okay, now some of these questions are not really relevant to what we were talking about. So I'm going to move on to the chart review. Um, because otherwise we'll just do questions about random things that people want to know about forever. So let me go over the charts. Oh, pull this up. Oh my God, I have so much research up right now. Give me a second. One second. All right, we've already been going for about an hour and 15, so I'm going to do this chart review pretty fast. I'm going to do it as if you guys weren't here. Okay? So remember on the last couple, I did it sort of like slowly to show you guys like what I look at and stuff. If you want to know how I look at charts, go watch those last two chart reviews. But the one we're going to do right now, I'm going to do it like as if I was at my computer alone. Okay? And so be mindful of that. And then we'll do questions at the end. But oh, wrong screen. All right. All right. So ENS, good. Amcor, fantastic as well. And then, as you guys can see, when I see these charts that are just like they're acting nice, right? Like, look, ENS not above its 9 EMA, but wedged here nicely. You know, Amcor, like, I mean, what are you going to worry about on these charts? Like, just totally constructive, right? On the weeklies, really is where I like to focus. And you can see, even despite this big selling, the thing could not get with the 9 weeks, so it just looks fine. OSS. Oh, OSS looks terrific. Really terrific. Wow. Great look on this one. And no points of concern. Synaptics hasn't really gotten going for us yet, but looks fine. And you look at this hugely accumulative volume profile down here. The weekly is really where my focus is and just looks superb. Look at that weekly right there, flagging. Hopefully, just busts out through that 200 week moving average at some point. But I like how this one's developing a lot. It may continue to be bumpy around this 81 to 85 area because, as you can see here, you're allowing this 9 week EMA to catch up to price. You'd like to see a pinch get created here. So that would be nice to see over the next couple of weeks, maybe it'll take another 2 or 3 weeks of consolidation for that to happen, but that's fine with me. I like how that's setting up a lot. That's one of the prettiest weekly charts in the market, in my view. Viavi, obviously getting extended here now after a monster run. Yeah, a little bit of extension here. I'd like to see this thing cool off a little bit. My contracts are almost up 1,000% on this thing, so they're up. What are they up? 920% as of today. So yeah, I don't mind if this thing cools off, but I mean, just look at this volume profile. Nothing but buyers. Beautiful to see. That monthly chart on this thing looks insane too. Just insane. Crazy. Pangea Logistics and GLDD have both been acting very nice. Yeah, gorgeous candles for Pangea. I mean, look at this one today on Pangea. 853 at the lows, recovered and closed at 880. GLDD just building structure wonderfully, defending this 21 EMA right here, the 21 EMA 20-day confluence, rip right off of it. I imagine no one's underwater on this thing. I can't imagine anyone who bought on my even if you bought at the top of my alert, like even if you bought this 1583 wick, there's no way you're underwater now. Stock's trading 16 plus. Um, yeah, on the weekly, these both look good. Like look at these high closes here at the top of the range on Pangea and same thing with GLDD. Both those look really nice. Let's look at LEU. LEU obviously structure is not superb on either the daily or weekly time frame. Looked great about 2 weeks ago on the daily, and now it does not. This sell is going to pull us down, probably if you look at the monthly here, in this 242 spot. I believe that's where we are trading right now, if I'm not mistaken, and after hours around 240s. So this thing's going to need some time, but again, what we do here is we look at this monthly chart, right? And we look at this structure that's forming here, and the structure is totally intact. So No concerns there either, despite the weak daily and monthly, sorry, daily and weekly looks. I mean, what a nice candle there. Closing the highs. Yeah, it just looks terrific. Nothing but accumulation here. I mean, look at the volume. Daily probably needs a little bit of work. Daily needs a little bit of work. Certainly needs a little bit of work. I'd like to see this push back into the low 400s. Nebius, their earnings are coming up. Wedged here under the 50. At least it retook the 9 and 21, which is nice. Very, very similar look on the daily and weekly here to what we just saw in LEU. Monthly looks terrific though, just like it does on LEU. Look at this monthly, it looks just absolutely terrific. Nice defense of that 9 month EMA. Despite all the daily and weekly volatilities, 9 month EMA has been held well intact. Um, I just continue to like this name, even despite the charts and how it's acted. I just continue to like the story with this name and how diversified their AI business is. So, not a name I plan on selling. Let's look at Kratos. Another one where the monthly structure looks great, and the weekly doesn't even look that bad on this one either. Compared to like I kind of group in terms of the action we saw in the last couple weeks, Centris, Nebius, and Kratos, kind of in terms similar terms in terms of the action we saw. The Kratos is defending the weekly chart much better than the other two. I think part of the reason for that also is the fact that Kratos was selected on that short list for the Department of Defense for their drone dominance program, which was released about 2 weeks ago. There's only 25 companies listed, only two public companies, and Kratos is one of them. So that was nice to see as well. THR has acted like just a beauty for us. Been no stress on this one, right? Not even any stress on the daily, really. I mean, look at the daily, how it's handled the volatility. Just rode the 90 EMA to the upside. Had a very, very strong earnings report. Obviously, the stock made its run prior to the earnings, so we didn't see too much of an earnings reaction. But very, very nice structure here on all time frames. Getting extended on the weekly, certainly. Could use a little bit of a allowing this weekly nine to catch up. I'd like to see that, you know. But other than that, looks good, looks solid. And on the daily, it's kind of not really begging for much of a cool down because this 9 EMA has found its way to keep up on the daily. So that does not look too bad. And then we'll look at Robinhood here as well to wrap things up. Oh, Robinhood, another bad earnings reaction. Looks like this downtrend's going to continue here. On Robinhood, and the weekly looks really ugly. Robinhood probably looks, in terms of all of my stocks, technically the ugliest. But I do think you will see some stoppage here around 62 to 66. So this local high here from March 67, and then you have your 100 week here at 62. I imagine in the 62 to 66 range. That's my guess. Don't put me on a um, don't put me on blast if it doesn't work out, but I do believe the stock's going to bottom around 62 to 66. Um, and that I think could be a really nice buying opportunity. Now, alternatively, they could release a catalyst sometime soon and just send this thing back up. But without a catalyst, that's where I'd see it naturally bottoming around there, the 62 to 66 range. And I believe Pup, our resident technical expert, actually called that out a few weeks ago of Robinhood going to 66. So props to him for that call. And then we'll look at GME real quickly. I know GME is just a lotto position, but is developing very beautifully. I mean, look at this daily structure. Just this is out of a textbook, right? This is out of a technical analysis textbook where you get a recapture of the 200 day, right? You have these wicks to try to fall it back below defense, clean defense of the 200-day, 9 EMA crossing the 200-day and supporting price simultaneously. See, price support at the 9, price support at the 9, price support at the 9. So you're breaking the 200, finding support there and finding support on a rising 9 EMA as well. And then you have this 21 EMA impending for a crossover with the 200-day here. It's about 40 cents away. So great structure on GameStop as well. So, yep, no red flags on any of my names as far as I'm concerned. I know I'm focused on a little bit of the higher time frames, but yeah, That's as quick as it takes me, guys. I mean, what was that? 8 minutes? Like that's what I do every weekend. I just go through these. I flip through the month, daily, weekly, and monthly, and I go, is there any red flags? If not, I just move on. You should do that every week for all your stocks. Okay. When I do the portfolio chart reviews formally, I take 2 hours to do it because I'm talking to you guys about every little metric and every candle. But when I'm doing it myself like that, I'm just quickly flipping through, getting a view of technical health, and then I'm moving on. So, yeah, everything looks fine in my portfolio to me. I don't see any red flags that I'm personally concerned about. So, yep, that does it for the chart review. Okay, we'll do some questions briefly and then we'll wrap things up. We'll do maybe 10, 15 minutes of questions and we'll wrap things up. Do you resonate with thematic approaches? I already answered that. Amcor question: how to evaluate when they're maximizing government incentives and their risk for canceled customer backlog, leaving them with inefficient capex versus excess capacity? How to evaluate when they're maximizing? I don't know, man. I haven't really thought about that. They're firing on all cylinders as far as I'm concerned. I did not expect them to be posting EPS beats in this environment. Like they're in a capex phase right now. They're building the biggest facility they've ever built. We're not doing chart requests. So don't do no questions about chart requests. We're not doing chart requests. We're just gonna do actual questions. If you have actual questions about anything I covered, or specific questions about a stock, you can ask me. But we're not just doing chart requests. Um, yeah, so with Amcor, look, the capex raise was a big factor in that report. A lot of people were like disappointed by it. I was not at all. I mean, to me, it says Peoria is going to be even a bigger project than anyone thought, and that's a great thing for them. Like the whole thesis around Amcor is around Peoria, in my view, and the capex is Peoria related. I mean, if you look at the description for their capex, it's all about their Arizona facilities, which I want to see. I mean, Arizona is going to become the Taiwan of America. That's what's going to happen. We're all the wheels are already in motion. So, um, Amcor is a proxy investment in American semiconductor industry. It's not just a packaging player. And so, yeah, I don't haven't really weighed the government incentives versus risk of backlog activity. That's not really something I'm thinking about. I'm just looking at their capex as a driver of Peoria. And I want to see Peoria be built as big and bad as possible. You know, Apple's backing that facility, TSM's backing that facility, Broadcom's backing that facility. So I want it to be as big as possible. I don't care if they dump another billion in it, to be honest. Um, See no option call March 20 what we should. I don't know what that means. You do whatever you want with your options. I'm holding them. How does momentum fit into your valuation approach? Is it when you ignore valuation and just let the stock run until it reverses? Was that how you sold UU and BE? It depends. It depends. I mean, there's stocks I own right now that I don't think the valuations are favorable. You know, like Kratos, Centrus, Nebius. I mean, these valuations are not great. Robinhood even, it's not super cheap stock or anything, but I still own them because my cost-based advantages are deep and I still like the story. And so sometimes, I would say valuation matters much more to me when I'm buying the stock, not necessarily when I'm holding it. I think part of holding a stock over time is enduring it being expensive at certain points in the cycle. That's part of holding a stock. A stock that you own is not always going to be cheap. So I don't think saying, oh, the stock isn't cheap anymore today, I should sell all of it is necessarily a productive investing strategy either. So I sell stocks when the thesis has failed. And sometimes I'm alerted to that because of a technical breakdown, right? So a lot of times the thesis failing is paired with a technical breakdown, right? So there'll be a technical breakdown. I'll go revisit the stock, ask myself the hard questions, and then realize, oh, there's a cockroach in the thesis. I have to get rid of this thing. And so that's when I sell stock. No, I'm just tired of every time I try to throw a nickel at Amazon, it just burns me. That's why I said that. I still love Amazon as a company. I'm not like saying ignore Amazon. I just every time the stock has not been a good trading stock at all for the last couple of years, and that's okay. But yeah, that's just not been a good trading stock. Would you consider adding Robinhood again to make it a bit of weighting, depending on where it fell to? Yeah, I would consider adding to Robinhood if it fell enough. If Robinhood fell to like a 25 forward PE, I'd buy more, but it's not there yet. That's not how you should think about buys, Mar. It's not like what's a good price to buy. You have to monitor the chart. Look for 21 EMA pullbacks. Look for 50-day pullbacks potentially, depending on how strong the stock is, and take a stab there. And then, understand that that's your risk. Stock can always break down below those supports too, but there's no like what's a good price to buy. That's not how stocks work. I can't just give you a number and round number and then you buy it at that price. It depends. Moving averages move. Moving averages move over time. If I tell you the 21 EMA today is at 43 or whatever, I tell you that's a good buy spot, it could be at a very different place 3 weeks from now. So I can't give you a whole number of when to buy. That's a lazy attitude. You should learn how to read a chart. A lot of names are trading near 90 EMA on the daily. You have a stock that is great, but at this time, I don't know what that means. Um, I mean, just because I'm reviewing a chart and saying it's okay, it doesn't mean it's a great entry. When I'm reviewing a chart and saying it's okay, I'm saying it's okay for me to hold it. And there's no dangerous red flags. But a lot of the stocks I own are up a lot. You guys have to be cognizant of that. Like your risk is higher if you're buying at a higher price than me, but that does not mean you shouldn't buy. Like that's up to you. I tell you guys what I do, you guys decide what you want to do. That's how this service works. I can't individually monitor each of your portfolios and tell you guys where to buy stuff. That's not how it works. You guys know when I buy, I tell you when I buy, I tell you what price I bought at, and then you figure it out from there. I mean, that's pretty straightforward. Is it a stupid question, but throughout the day, are you constantly checking charts or making trades? No. No. I mean, if I was making trades all the time, you'd see them in my journal. I mean, I don't day trade, so no. I'm not sitting around making trades all day at all. Nothing close to that. I'm doing reading research more than anything. I monitor price action quite a bit. So I have a big Webull comprehensive watch list with like 1,000 stocks on it. I look at that all the time. So I monitor price, I read research, but no, I don't click buttons all day. That's for losers. People who click buttons all day and day trade all day, like that's a loser's game. That's not how you make real money in the markets. Like maybe less than 1% of day traders are successful. No, I've not looked at Cody again. I took a pretty big loss on that last year, so I'm not revisiting it. I have not bought more OSS since 471. Um, ENS is, I still love that stock. Is it my favorite stock in the market? I mean, by virtue of my weighting, yes, but the report wasn't overtly satisfying to me. I wanted to see more top line growth. So it wasn't a perfect report by any means. Did it change my conviction level in owning the stock? No, I still own the stock. Um, but no, I do want to see that top line acceleration from them. I do want to see that. And so I'm going to give them a few more quarters to do it. Right? I'm giving them some leeway because the structure is okay. The stock has acted well. It's rebounded well. I mean, it had a beautiful 9% rebound the day after the earnings sell off. So I like how it acts. I like the institutional ownership levels on it. I like the cheapness of the stock. So yeah, I still really, 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 really like the stock. And by virtue of my weighting, yeah, it is still my favorite stock on the market. Now, is it, does that mean it's unconditional? No. If the next quarter and the quarter after they don't show that top line growth, I may sell it one day. So everything is conditional. I don't marry stocks. They have to prove to me that they're worth owning. But yes, for now, that quarter was fine for me. Yeah, it wasn't great, but it was fine. But one quarter doesn't make or break a thesis. At what point do you give up on an options position that the stock is still very choppy? I don't really. Usually for my options, my stop is my size. My stop is my size for options generally. Have you found more success with your valuation process looking at pure plays or companies with multiple businesses? Pure plays have always been more successful for me. That's too broad of a question, SDF. Too broad. Be more specific. Based on this earnings, what do you think LEU deserves to hold? 220, or do you see it dropping below 200 now? That's not how I think about stocks. We mean deserves to hold. It wasn't a great report. They had a big EPS miss, but if you've paid attention to that stock over time, APS cadence is very, very tricky to predict for that stock. So I don't know what you mean by do they deserve to hold it. We'll see if it holds. That's the better perspective. What do you want to know about my thoughts on that company? What are your thoughts on a company is too broad of a question. You ask me a question about it and then I can answer. I have trouble with exiting to cut a loss. The problem is I have daily structure may break down, but the weekly is still intact, and the way weekly bring a monthly and stack and wait for the difference. But I cannot. Yeah, that's the thing. It depends on where you bought it. You can't just okay, if you buy a stock and it starts breaking down the daily, you can't just flip to the weekly. You only have the liberty to look at the higher time frames if you bought early. So yeah, if you bought recently, you can't do that. If you bought yesterday and then you go underwater today, and then tomorrow you're like, it's okay, I'll flip to the weekly chart. No, that's how you create a huge bag. So yeah, stocks and bonds, you should not do that. If your cost basis is close to price, and to reiterate this, if your cost basis is close to price, you do not have the liberty of flipping to the higher time frames. You only have the liberty of flipping to the higher time frames if you have a deep cost basis advantage. Period. End of story. Otherwise, you're going to result in holding a huge bag. They're just not, the Cena calls just aren't liquid enough. I looked at some of the Cena calls. I just couldn't find any with enough liquidity for what I wanted. That's why I didn't get calls. But I upsized the position. It's like almost in whatever, 7.5% weighting now. So, yeah, and I'll upsize it again. If it comes back to like the low 80s, I'll upsize it again. I'm willing to go up to 10% weighting on Synaptics. Well, no, I wouldn't just buy it. You'd have to like, I mean, look, we'll look at Amcor real quick. I mean, you don't want to just buy it here. I mean, could it break out? Yeah, but that's not a technically favorable entry. What you want to do is wait for some kind of retest of these moving averages. They're curling up. That would be an ideal spot to buy it, but not here. And if you don't own it, I mean, that's just unfortunate. There've been a lot of opportunities. Why didn't you buy it here? 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 Well, probably because price is going down, right? So don't get FOMO just when a stock's going up. What is your favorite thesis confirming report on your holdings so far this earnings season? Viavi has been the best report by far in all my stocks this earnings season. What do you think your analysis broke down? I didn't do a tremendous amount of analysis on CRML. That was a meme play. I am Jordy. He was asking why I didn't buy more. Worried about the March Cena calls? We still have a lot of time left. I don't know. We'll see what happens. I still own them. I mean, it was nice when my community was a little smaller, but I don't mind it. No, I don't have a sense of which way a random stock will move in my portfolio tomorrow. Of course not. I don't think about that. I don't think about how my stocks are going to move on a day-to-day basis. I think about technical structure. Are they still intact? Are they going to move well over a given period of time or not? That's what I think about. Any questions about what we went over fundamentally, or any questions about any of the chart reviews that I did that you might have deeper questions about? I think Google had the best results out of the Mag 7, and then probably Meta number two. I don't use any indicators for technical analysis. I just use price, volume, moving averages. I think all indicators are useless. Thoughts on A-Lab earnings? I didn't look at them. I don't own the stock. Okay, let's keep this question stock related. Say Drake so I can sleep tonight. I like some Drake songs. Is it funny? All right, is that it on questions? What do we think? Any pressing questions at the top of anyone's mind? I don't know. It's just like feels like an overly talked about trade with the SpaceX IPO. I might pick up some space exposure at some point this year, but I'm not like running to do it or anything. It's the same thing with cybersecurity. I mean, me and Evan were talking about cybersecurity today. There's some cybersecurity stocks that I like, but I don't know if I can wrap my mind around valuation right now. So we'll see. The next stock I pick is probably either going to be one of those drone supply chain names that I talked about, or a cybersecurity stock. But I haven't made up my mind yet. There's also some financials I'm looking at, which I really like actually. So that could actually be it. In fact, it probably will be a financial because those are the most compelling to me right now. But it's not going to be a retail financial. It's going to be probably a mid cap bank. Yeah, we'll do more workshops on fundamentals with more detail. Today I had to cover a lot in one workshop, so that's why I was a little bit scatterbrained about it. But you should be able to go back through this recording and pick up some useful cues. Even though there was some stuff that I kind of reiterated and some stuff I kind of brushed over, there should be enough useful stuff in this workshop for you guys to get a basic idea of how to do fundamental analysis. Yeah, Juventus, you should stop buying calls then. Um, if you're struggling with options, you should stop buying options. It's pretty simple. You're either sizing them incorrectly or you're buying jacked premiums or you're market ordering fills or something. I don't know how you're down on GLDD calls. That makes no sense. GLDD is like in the 16s now, so I don't know how you're down on those, but or Pangea Logistics, honestly, I don't know how you're down on those calls either. That stock is like almost $9 now. Yeah, NTCT looks all right. Dude, I didn't love their last earnings report. A lot of people were really gung ho about it. Like, were tagging me. Like, did you see their amazing earnings report? Like, they had a nice EPS beat, but they're not even growing revenue year over year. That's concerning. So I didn't love that NTCT report. It's probably if I do buy a cybersecurity stock, it's probably not going to be NTCT, even though that does have a nice chart. Probably not going to be that one. I know I owned that one previously, but I don't think I'm going to re-own it. I don't know. They're just not liquid. I don't know why. A lot of stocks don't have liquid options chains. Smaller company, a $3 billion company, that happens a lot. No, I mean, again, the Pangea logistics thesis has nothing to do with whether Trump takes Greenland or not. It's about Arctic activity. But yeah, I do think in the midterms there's a chance that some of the Trump themed trades will get tossed if they lose the midterms, which the polls seem to be indicating. Yeah, I've looked at Rubrik, a little too expensive for my taste. I don't really understand like underlying path to profitability. So I'm struggling with wrapping my mind around Rubik. If I pick a cybersecurity stock, it's not gonna be that one either. The ones I'm looking at are probably you guys probably are not gonna guess them. It's not NTCT, it's not Rubrik, it's not the popular ones. All right, that looks like all the questions. Um, I'll see you guys tomorrow as usual. Go back, listen to the recording. I know it was a bit scattered in terms of the organization, but we did touch on a lot of important stuff. So go back and think about that and think about valuation. Um, and remember, just like everything else, like technical analysis, fundamental analysis is about the work you put in and not about like how easy can I make it? You know, can I plug it into a spreadsheet and find an ABC formula? The more you try to make markets black and white, the more you will be a member of the herd. Okay? The more you try to oversimplify analysis in markets, the more you'll just be rudimentary and mediocre. Okay. I don't know any good stock pickers that just like pick stocks on a whim. Um, I just don't know any. Over a long period, like the people I know that have been doing this for like over a decade or over 20 years, some of them, some of my mentors have been doing this for over 30, 40 years. None of those people who are good stock pickers do it without work, like real understanding of the industry, understanding of the metrics, putting context on everything. That's how you become a good stock picker. So the lazier you are, the worse you'll be. Period. The lazier you are, the more you want to be spoon-fed, the worse you'll be. And so keep that in mind. If you want to make a lot of money in markets, you have to put in a lot of work, just like anything else in life, right? Um, there's no free lunch. So go back, study what we talked about. Let me know if you have questions. I'm always here to answer questions. If you do ask me questions, ask me specific questions. The broader your question, the worse my answer is going to be. And so always keep that in mind. But anyway, I'll get this recording uploaded whenever it's uploaded. It takes like 10 or 12 minutes, sometimes longer, for it to upload to Zoom servers. And then I'll upload the recording. So don't tag me 500 times asking when the recording's going to be up. It will be up when it's up. But anyway, I'll see you guys tomorrow and later. Obviously, I'll be here all week. So tag me if you have any questions. I'm gonna be pretty busy these next 2 weeks because I'm moving into a new apartment, so I need to like get stuff packed and stuff. But it's pretty close by, so it's not going to be like a huge issue or anything. But I do have to move, so that is going to be something that I wrap up. And I'm going to be busy with errands a lot over the next couple of weeks. So just be mindful of that. But we'll still be doing workshops. I'll still be here, still be answering questions. Okay, have a good night. Take it easy.